In this example, we are going to look and prepare a classified balance sheet. So hopefully in your reading and watching the videos within the text and Cengage and Angel, you learned a little bit about what a classified balance sheet is. A classified balance sheet is similar to a balance sheet, only what we do is we take and further categorize the different classifications on the balance sheet. So we know that the balance sheet is assets equals liabilities plus owner's equity. But what you can see here in front of you is we've taken our assets and we've further categorized those into current assets, investments, property, plant, and equipment, and intangible assets. And they are listed in that order on the balance sheet. So I've taken the information up here and I've put in our current assets information. So current assets are all the assets that can be liquidated within a year or less. So turned into cash within a year or less. And then they are listed on the asset in order of liquidation. So we have our cash, accounts receivable, merchandise inventory. All of their amounts added together give us a total current assets amount. Then our investments are next. And we only have one investment and it just tells us investment and long term. So long term means it goes into the investment section and it is $1,000. We can have short-term investments as well, but those will belong in the current asset section. Then property, plant, and equipment is going to be any of our depreciable assets, and also you could find land in this account. Keep in mind land is not depreciated though. So these are going to be our property, land, plants like the building or warehouse that we use for our company, and then any equipment we use, like again, that could be depreciated. So it's going to have its accumulated depreciation account, its contra account along with it. So in this section of the balance sheet, we always list our asset, and then right underneath it, we list its contra asset account, which gives us a book value or carrying value. So in this situation, our equipment is valued on our books at $4,600 because we have depreciated or spread out the cost of that equipment over a period of time. Then we have our intangible asset section. The intangible assets are going to be the assets that provide benefit to our company, but we can't see or touch them. So a franchise would be an example of that. If we own a business and we're part of a franchise or a chain, it gives us a lead or a head start, if you will. It's a benefit because of the names and things that are associated with the franchises. So we add our total current assets, our investment, our total property, plant, and equipment, our franchise, and we come up with $9,800 for our total assets. Then we have our liabilities, and liabilities we split up into two categories, current and long-term. Current liabilities are going to be the liabilities that have to be paid off or will be paid off within a year or less, where current liabilities will be paid off in a time frame longer than a year. So our accounts payable is $1,600 and our wages payable are $200. We add those together and we get total current liabilities of $1,800. Then our notes payable is long term, because if we scroll back up here it says notes payable long term. So we don't know. Sometimes you have to pay attention to the timing it actually gives you to figure out where to classify it. But in this situation it told us it was long term and it was $800. So then our total liabilities, current plus long term, is $2,600. And then in this example, you'll notice that capital has a big question mark by it. So what we had to do here was actually calculate what our owner's capital is by using the accounting equation, total assets equal total liabilities plus owner's equity. Since I was able to calculate my total assets, I know that my total liabilities plus owner's equity also must equal $9,800. So I took the $9,800 minus the $2,600 and was able to get my total owner's equity of $7,200.